Hello and a very warm welcome to this week's Policy Watch, our weekly program on the major economic developments during the week. This week we kick off with a discussion on the doubling of the price of natural gas announced by the government on Thursday. Our next story is on the implications of the better than expected numbers for the current account deficit for the fourth quarter of the last fiscal. And we finally close with a look at some of the major changes announced by the capital markets regulator SEBI. Joining me in these discussions is Puneet Jain, former chairman of the Jaipur Stock Exchange. Welcome to Policy Watch, Puneet.
Thank you, Mythili.
After years of dithering and endless controversy, the Cabinet Committee of Economic Affairs, the CCEA, finally approved a doubling of the price of natural gas from $4.2 per MMBTU, that is metric million British thermal units, to 8.4 MMBTU. The new price, which comes into effect from April 2014, is based on a very complex formula proposed by the Rangarajan Committee and is likely to lead to a hike in the price of power tariffs, increase in fertilizer costs, and make CNG transportation also more expensive. Preliminary estimates suggest that power tariffs are likely to go up by as much as 4.70 per unit for gas-based power plants and by almost 16 to 20 paisa in other cases. Needless to say, there is no free lunch, so the tab will finally be picked up by consumers, either directly by way of a hike in the price of power and of fertilizers, or indirectly by way of a hike in the subsidies and hence in the fiscal deficit and therefore taxes. But before we go into a more detailed discussion on what it means for you and me, let's hear this report from our bureau.
It was never meant to be easy for the government faced with criticism on account of high inflation. But on Thursday, the Cabinet Committee on Economic Affairs finally approved nearly 100% hike in the price of natural gas produced in the country. As per the formula suggested by Dr. Rangarajan Committee, the new price is expected to be $8.4 per unit, which is double of the current price of $4.2 per unit. The current price was fixed in 2008 and was valid for 5 years. The new mechanism provides for quarterly revision in the gas prices. It is expected to increase the cost of generation of electricity produced by gas-based plants substantially and would also make CNG transportation and fertilizer more expensive. Power and fertilizer ministries were against the steep hike because of its impact on power tariffs and fertilizer prices. Petroleum Ministry had suggested the new price to be $6.77 per unit. However, the Cabinet Committee on Economic Affairs ignored the suggestion and approved the formula advocated by the Planning Commission and private players, but it is expected to bring more investment in the sector and ensure gas supply to gas-based power plants with 18,000 megawatt capacity that were lying idle due to no supply. Bureau Report, Raj Sabha TV.
Puneet, we just heard the details of what the government has announced yesterday. But tell me, should the government be in the business at all of fixing prices? After all, in the case of oil, we've seen them slowly move away from regulated prices to deregulated. So why in the case of gas has the government seemingly gone back on any kind of, deregulation?
Actually, this is naturally a legacy issue. See, we have had a mechanism where government was fixing petroleum prices as well as gas prices. This is basically earlier used to be a byproduct of the normal exploration activity. It is only in the recent years that gas has really become one of the primary sources of fuel for any economy. And therefore, of course, this is a weaning away process, where government has to evolve a mechanism by which it moves away from the administered price mechanism, the APM, to a market driven policy. But as we know, it's a very complicated thing in the sense that it involves a lot of money, apparently hundreds of billions of dollars. It also involves millions of consumers and producers. So it's not something which is easily done. It's very easy to probably to say that we should just do it, but with millions of stakeholders involved. And we know that people will cry foul about prices going up, there will be inflationary pressures, there will be other concerns. So it's not an easy human decision. It's an easy economic call, but I'm sure it's a very complicated human decision to take.
But government had made a beginning in 2003. If you remember, Reliance had bid out its prices, gas fields, based on the, some kind of formula which was approved by the government. But now again, the government has interfered in the entire pricing mechanism. And if you see, whenever government gets into the act, which is why there's so much of problem, you have to balance the interests of producers and of consumers. And producers, though they are few, particularly in the case of gas, they are very few. But even so, they have much more power than consumers, who are so many but completely dispersed all over. So how does government balance the interests of producers and consumers? And how fair is it to say that producers have an edge because they're able to lobby so much more successfully?
See, naturally, the consumers are many numbers and they are not a lobby per se. Although you can say that, okay, fertilizer companies or power companies are a group, interest group, so they can lobby as a cohesive group. But the truth is that there are large number of consumers, let's say in case of CNG, which are auto consumers, they will not be able to lobby with the government. And apparently there are only few players, 2 or 3 players who produce gas. So on the face of it, it appears that the producers will have more cohesive approach to lobbying than, let's say, the other consumers. However, see, 2003, when Reliance started by bidding for the gas fields,
yes.
See, the dynamics of oil industry has changed dramatically. The prices were used to be about $25–30 a barrel of oil, and now it has gone up to about $125 a barrel. So the oil dynamics, oil industry changed so enormously in the last 10 years.
US itself has become self-sufficient now because of shale gas. So one
and
really
US
cannot say.
Had to do it. See, US could never imagine going to shale gas. They thought the oil would always be cheap. They'll be able to grow on the back of cheap oil. That didn't happen. So US had to find an alternative to go into deep sea exploration to get shale gas. So clearly the oil economy in the world changed so much that governments were behind us. And of course we know that governments are usually slow to react to any dynamic change of this
kind. But there's just been this report today by the brokerage house CLSA which says that actually Reliance, the private sector player, is going to benefit the most as compared to public sector players because they have to kind of pass on some subsidy, there's a subsidy element cost. So tell me, given all this kind of controversy and the kind of flack it is going to give rise to, should the government have taken a decision like this so close? This is going to come into effect from April next year, and the government goes in for elections just a month after. So do you think it is right on the government, or there's nothing wrong perhaps, but in the niceties, because after all in the case of the budget you have a vote on account. So should the government have desisted, announced only a temporary interim price hike, or is the fact that the government says that no, we have to announce prices sufficiently early so that we get investment into that sector? What do you think is more valid?
Mythili, this would have been the right process if the economy was going through normal times.
Okay.
But we are not going through normal times. We are going through extraordinary times.
Absolutely.
There's huge volatility in the world markets. There is enormous pressure on the Indian rupee. And I would say, I would dare to say that the Indian economy is in a state of crisis, which is next only to what we saw in 1991. And therefore, I think there is a need for extraordinary
circumstances require extraordinary steps. Sorry, Puneet, I think I'll have to interrupt you there, but we'll be back soon. On that note, please, let's take a break now. But we will be back soon. Please stay with us. Welcome back. And that brings us to the next story on the country's current account deficit, or the CAD. Unlike the gas price hike that's bound to result in some winners and some losers, this is a happier story all round. India's current account deficit, or the CAD, moderated sharply to 3.6% of the GDP in Q4 of 2012-13 from a historically high level of 6.7% of the GDP in Q3 of the last fiscal, thanks largely to a smaller trade deficit. As a result, the CAD for the year as a whole ended at 4.8%, higher than 4.2% for the previous year, but well within the projected 5%. We'll go into the implications of that, particularly for the battered rupee. But before we do that, let's hear this Bureau's report.
India's merchandise exports recorded a growth of 5.9% in the 3 months to March 2013. And a marginal decline of 1% in merchandise imports during this period brought down India's current account deficit to 3.6% of GDP from 6.7% in the same period last year. During the March quarter, non-oil, non-gold imports declined due to subdued economic activity at home. India's trade deficit, the gap between exports and imports, stood at $45.6 billion in the quarter. The trade deficit for the same period in 2011-2012 was $51.6 billion. The current account deficit, the difference between net outflows and inflows, stood at $87.8 billion or 4.8% of GDP, compared with $78.2 billion last year, which was 4.2% of the GDP. However, it is still below the projected level of 5% for this year. Bureau Report, Rajya Sabha TV.
Puneet, that was some decidedly happy news in an otherwise rather bleak macroeconomic environment. But did that happy news come a little too late for the rupee?
Not really, in the sense that I think people are expecting much worse numbers, and it was a surprise that the CAD was so low. And not only that, the financial year 12-13 we just ended, we had a positive balance of payments. So actually there was no net outgo from the country. Of course, we were helped by copious flows in terms of equity investments and debt investments. But the fact is that the Indian rupee should not have depreciated so much as we saw. So I think the message really was that the markets overreacted to the CAD numbers which we got in the December quarter.
Did they really? Because if you look at the figures for April and May, the trade deficit was quite high. April was about 18 billion, May was about 20 billion. So clearly we're going to see in the first quarter some reversal of this happy news. So generally the estimates are the CAD will be somewhere around about 5.5%. So will that take away from all the temporary gains that we've seen, or do you think markets have now stabilized?
I think markets will stabilize. They're still going through a lot of turbulence and markets have to settle down. Typically for a quarter, we should be seeing I mean that's what we desire. We should see a CAD of about $20 billion. See, we are roughly a $2 trillion economy. Economists believe that about 3% of the GDP, if the CAD is within 3%, then we are in a happy situation. We are in a comfortable situation, which means $60 billion is our target deficit for a year. That means we should be doing about $15-20 billion in a quarter. Of course, I think April, May, June is going to be a very tough quarter. But also we must remember that January to March quarter is when a lot of remittances, a lot of money which is which stands outside on account of exporters, that comes in. So generally January March quarter is a very good quarter. We of course will have a certain extraordinary situation because of gold imports in the current quarter, but I think things will improve. If you look at the overall situation in the current year and the expectations, I think we will be somewhere around 4.5% of GDP. And going forward, that should also improve. So I think the worst in terms of CAD is behind us.
So it's already over.
Exactly.
You track the portfolio flows in the stock market very closely. So more than the CAD per se, it is the financing of the CAD which is very important and very worrisome also. Given the fact that we have this huge reliance on portfolio flows, and given that you track portfolio flows in the markets in general so closely, what is your sense? Will we get the necessary flows? Will they be all portfolio? Can we hope for some foreign direct investment too?
See, this is another story actually, and it's a very complex game. We have seen, in fact, and our Reserve Bank of India has consciously called or invited investors to put in short-term money in India, because we have been raising the limits for ECBs, we have been making it more attractive for foreign debt funds to come and invest in India, without realizing that these funds are very hot money. No? They really flow out at a drop of a hat. And we saw just about $3 to $5 billion being withdrawn from the Indian markets in last 1 month, and we saw the rupee depreciate by over 10%. So it's really, we are really sensitive to those kind of flows, and unless we have a market which can really absorb these kind of inflows and outflows easily, I don't think we should really be looking at ECBs or debt funds as a major source of funding the CAD. The problem was we were comfortable because we had huge debt flows, and we said, okay, CAD is being funded comfortably. I think it's been a good lesson for India. We of course know that countries like Brazil had a huge fall, and Argentina went through a major crisis in early 2000s because of this reason. For India, I think we have learned our lesson, and going forward we should be able to change this.
So how do we reduce our dependence then? How on these portfolio flows? You agree that they're fickle flows, it's easy come, easy go, but given the situation that we are in, it's a bit of a catch-22. So what is the way out?
See, clearly the solution is to cut the, as you know, current account deficit essentially is the sum of three factors. One is the trade balance of trade, where imports and exports are balanced. Then we have the dividends and interest income for the country, and we have the remittances or transfer payments which come in. So clearly the trade balance, which is the deficit arising out of imports and exports, that has to shrink. That is where we will win this battle. We can't hope to rely upon dividends and interest to win the battle for us. So clearly we need to push exports. Unfortunately, Mythili, and you have really watched this over the years, over the last 10-20 years, that that depreciating the currency does not help us. Somehow for India, we have seen a depreciation of the rupee from 22, 23 levels in 1991 when the economy was opened, and in last 20 years we have gone from 21 to 60. Has it made our life easier? It hasn't. So I think
tough choices before us. That's
it's
all.
A tough choice.
You need to cut your CAD, but it's very, very difficult to do that.
Difficult.
But on that note, Puneet, we'll have to take another break. Well, please do stay with us. We'll be back soon. Please stay with us. Early in the week, the SEBI board announced a number of changes in its existing norms with two views really mainly. One, to make buybacks tougher for companies, and secondly, to ease the hurdles for foreign institutional investors wanting to invest in India. Both these moves will have far-reaching consequences for the stock markets. Puneet will take us through the implications in greater detail. But first, let's take a look at this bureau report.
The stock market regulator has issued fresh norms for share buyback by companies. These rules are aimed at protecting small investors and preventing companies from making misleading or frivolous offers. As per the new norms, it is mandatory for companies to buy back at least 50% of the proposed offer size. Failing to do so would attract a penalty of 2.5%. Companies must keep 25% of the buyback amount in a separate account and complete the process in 6 months. There will be a 1-year cooling off period between the two buybacks, and companies cannot raise any funds during this time. These measures are intended to discourage companies from using buybacks to jack up the share price. This week, SEBI also simplified the procedure for bringing foreign investment into India. Foreign institutional investors, sub-accounts and qualified foreign investors have been defined as a new class of foreign portfolio investors. This QFI category is again divided into 3 categories of sovereign investors, banks and mutual funds, and a third category for all the other investors. Bureau Report, Rajya Sabha TV.
Puneet, this is your forte, the stock markets. Now tell me, SEBI is considered, the guardian or the regulator, of course is the regulator, but is the guardian of investor interests. Now do these changes, particularly in the buyback norms, do they make it better for consumers, investors, or is it better for promoters? Which way does it go?
No, definitely it helps consumers or investors, as you may call them. The fact is that a lot of companies over the last 3-4 years we have seen who were not serious about buybacks. They would just make that announcement and try to send a message to investors that they can invest in the company, believing that the promoters themselves believe in that stock. And we saw it never happened. So clearly, I think these norms, stringent norms, will definitely help investors. I think they're really called for, and they will really help the markets become more reliable, safer for investors. So clearly, no two ways about it. I think they were badly needed. As far as foreign investment norms are concerned, the foreign portfolio investors is concerned, that is also welcome, because see, we have had these people who are coming from sovereign wealth funds or government entities, and they have to go through lengthy procedures of first registering with FII, with SEBI and then investing. I think it's welcome. It will really simplify the money which is coming in as foreign investments into the markets. It will help. However, Mythili, here I would like to focus upon something which gets lost usually. See, in our rush to attract foreign investors and simplify things for them, we have forgotten that we need a similar approach to investors in Indian market. I mean, do you know?
You feel Indian market?
Indian investors.
Investors are being discriminated against.
In 1992, when liberalization started, India used to have about 4.5 to 5 crore investors in the retail market, in the retail equity markets. Today, we have less than 3 crores. We have about 2.6, 2.7 crore retail investors in the markets, which is a bad idea. I mean, what has happened to markets, a free economy growing on the basis of strong capital markets? It didn't happen in India, surprisingly. So I think SEBI needs to take this initiative further to extend it to domestic investors and make risk-based KYC norms applicable even to domestic investors. I think that's
SEBI has
important.
tried to do a number of things, particularly the mutual fund route. It has removed entry load, exit load. But the fact of the disinterest of domestic investors is partly because financial instruments themselves have become so unattractive, given the high inflation, low returns, etc. So what more can SEBI really do?
No, that's true. But are you aware that in case you want to, let's say you want to invest 10,000 rupees in stock markets, you have to go to a broker first and open an account. The account opening form itself is a 60-page document in which you have to sign at least at 40 places. So can a person who is not financially savvy or who is not sophisticated, I myself I have been investing for the last 10 years. I myself have never read any of these forms myself.
That's true.
It's an impossible thing to do.
But you saw what happened in the banking sector with the same KYC norms. You saw the kind of irregularities that were happening. So where does one draw the line between having complicated KYC norms that perhaps put off people, or having very simple KYC forms and at the same time, leaving the entire door open to all kinds of suspect money coming
No, exactly.
in? Where does one draw the line?
We should do this risk-based kind of KYC, which they have done in case of foreign investors, that people who have putting in large sums of money, who have the ability to swing the markets, who have the ability to influence the markets, we do some kind of a KYC for them. And for smaller people, I mean, just imagine if you want to buy a 10,000 rupee investment in equity markets or mutual fund, you have to fill this form, which is 50, 60 pages. But you want to buy gold. You just put 10,000 rupees in your bag, go to the next door goldsmith and buy gold. I mean, you have to do nothing. So it is natural that people have weaned away from investment instruments like equities or mutual funds or other formal instruments, and they've gone into informal instruments like gold. So I think SEBI or the regulators have to understand that aspect, that if you make it so difficult in the name of regulation that investors find it so very tedious, very difficult, we'll see the numbers dwindling. I think that's an important thing. While foreign, and this was happening in foreign investors also. Foreign portfolio investors were facing similar problems.
So that's why you had the entire concept of participatory notes and all that kind of thing, with a lot of fudging, a lot of lack of transparency. So what you're suggesting is the same differentiated kind of KYC that you have now allowed for FIIs.
See, in smaller towns, smaller places, villages, people are not savvy enough to go through these.
But are they savvy enough to invest in the stock market itself?
They would be. See, you have to allow them. That's why I'm saying that you allow them to come in small numbers. You do a KYC or a stringent thing if, let's say, a trade turnover in a particular account exceeds 1 lakh rupees or 2 lakh rupees. No, do some risk-based KYC or this kind of regulation. But if you do it for the smallest guy, and let's not forget that he has other options. No? See, it's not as if you are preventing him from, look at parabanking, look at what has happened in parabanking. A company in UP can go ahead and raise 20,000 crores from people at a retail level. I mean, that's a downside to this whole over-regulating one sector and letting other sectors go scot-free. So I think that's
SEBI also announced a number of other measures, Puneet. Would you like to kind of very briefly touch upon the other measures they announced?
See, of course, SEBI has now rationalized a lot of things. For example, in case of debt markets, they have allowed funds to trade directly in the proprietary accounts. So SEBI is definitely moving towards making the markets safer, better, more transparent for investors, and which is a good idea. So people today do not complain about the fact that markets are not safe for retail investors, or they can't get into the markets in terms of risk profile. But earlier it used to be there. I mean, a lot of companies would just come in, they were fly-by-night operators, they will skim the money off people, which is very good.
Wait,
so
that hasn't disappeared entirely. You still have those kind of...
I know, but you had those vanishing companies, you remember?
Yes,
400, 500 companies.
True.
5,000
That has come
companies.
down, certainly.
That has really come down. So to that extent, I think we've done a major service to investors in India. We only now need to see that the base grows. People are able to benefit from growth in that industry. And that's important. So SEBI has really played an important role. I would really give SEBI credit to be able to do these kind of things. It's very difficult. They're mostly unpopular steps, and government officials would feel very hesitant to do this. It generally doesn't make people happy. But SEBI has been a very bold organization in that sense. They've really gone ahead, taken these steps. They need to pursue these ahead. Only thing is, I think we need to see that the retail investor, the person at the bottom of the heap, he also gets a voice. He gets
so I think on that note, we'll have to wind up this program because we're coming to the end of the time. But before we do that, we need to wrap up whatever our discussions are yielded. So I think basically, as far as the gas price hike was concerned, you felt that extraordinary circumstances forced governments to take extraordinary steps. As far as the current account deficit was concerned, you were, well, not so optimistic, at the same time feeling that we need to do something about the current account deficit. That means, tackle the cause rather than the symptoms. As far as SEBI's announcements are concerned, you showed us where your heart lay. Clearly, you were a small investor. And on that note, I think we'll come to the end of this program. Thank you so much, Puneet, for being with us. But please be with us next time, same time next week.